Good afternoon, everyone. My name is Susan Howard. I'm director of the BATIC Institute at AASHTO. Welcome to this afternoon's webinar. Build America Bureau is open for business. We're pleased to partner with the Build America Bureau to bring you this webinar today to learn more about their products and services. Just want to touch on a few housekeeping items. This webinar is being recorded, and we will have the recording and the slides available on the BATIC website, financingtransportation.org, within the next couple of days. For those of you who are new to the BATIC Institute, just to give you a brief overview of what we do, we work to promote public sector capacity building in the analysis, understanding, and use of project finance techniques through training, sharing of best practices, and technical assistance to state DOTs and their local partners. This webinar series is certainly part of that. We do a number of webinars and would welcome you to take a look at the resources available on financingtransportation.org to see more. You'll notice that there is a question box or a question tab in your GoToWebinar box. We'd encourage you to submit questions throughout the presentations that we hear, and we will dedicate some time at the end of the webinar to getting to those questions. Today we're going to start off with a few polls to get to know our audience a little bit better. So you'll see the first of those coming up shortly. First one is, what kind of firm or organization do you represent? If you could please respond to the poll. Okay, thanks very much. The second question is, how familiar are you with the Bureau and its products? Okay, third question, what brings you to today's webinar? Very good. Next is, I'm interested in learning about how the Bureau intends to, if you could fill in the blank. So I'll go ahead and turn things over now to Dr. Morteza Farajan with the Build America Bureau to introduce today's panelists and provide an overview. Again, thank you all so much for attending.
Thank you very much, Susan, and good afternoon, everyone. My name is Morteza Farajan. I'm Executive Director of Build America Bureau, and today I'm here with two of my colleagues, Duane Callender, who is head of our credit team, as well as Roger Barnard, who is head of our project development and outreach team. Those of you who know me, you know that I'm a very practical person. I come from a state DOT background. I've been with the Bureau for about a year, but prior to that, I was with Virginia DOT. And that experience with Virginia DOT, working with multiple projects, whether they were P3 or non-P3, has enabled me to start thinking outside the box and start thinking about how we can develop products, services that can help different project sponsors at different levels, whether they have a small project at local level or whether they have a larger project at the state level, whether they are working on a public-private partnership project with their private partners. There are multiple tools that they probably need in order to advance their projects. And today we are here to talk about some of the tools that we have been able to develop at Build America Bureau that can help different project sponsors. And you will see that in the table of content, we have multiple topics that we want to talk to you about them. Some of them you might be familiar with them. Some of them might be a little bit newer to you. You may not be as familiar with them. And today is a great opportunity for us to be here with you to talk about some of those products. Going to the next slide, I would like to talk a little bit about the priorities that we have. Over the last year or so that I have been with the Bureau, I have been focused with the rest of my team on how we can deliver more good projects faster. We have been able to grow a very good, robust project pipeline. Thanks to Roger and his outreach team, we have been able to reach out to a lot of project sponsors and work on very good projects that hopefully within the next couple of months we will see those projects moving to our credit worthiness stage. We have been very focused on how we can diversify our portfolio. whether it's geographic diversification, reaching out to states that have never used our products in the past, trying to work with them in order to identify what are different options that they may have available, different opportunities that can enable them to use our products, as well as working on different asset classes, not only focusing on toll roads, but different types of projects that can benefit from the products that we have. We have been also very focused on how we can promote innovative project delivery models, how we can look at different options that people have, different tools that they can have in their toolbox in order to think outside the box and advance some of these projects faster, more efficiently. We have worked internally on how we can streamline our credit application process. Duane and his team have been very focused on identifying opportunities that we have in our own internal process that we can utilize to streamline that process, become a little bit more efficient, a little bit faster, so that we can provide a better service to you all as you go through the process with us. We have also identified opportunities that we can work with you in advance to make sure that we do have everything that we need in that stage to move the project forward faster. So we plan well in advance to get these projects move forward faster. We have been able to assist underserved stakeholders, communities, and new borrowers. I have personally traveled to 10 states, and if it was not because of the current conditions that restricts us from traveling, we would have probably had more states covered within the last couple of months. My goal is to be able to go sit with those folks who have never used our products in the past, sit with them face to face, and explain to them that how these products can benefit their state, their program. And oftentimes the response we have got is very, very positive. When people start understanding how different products can come together and help them, they start thinking about how they can use them in their states. And finally, I want to mention that we have been fully engaged with our partners during past couple of months. Although we have been working from home, we have not been able to be in office, but my team has been very efficient, very good at working with different partners. As a matter of fact, we have closed some loans within the last couple of months, all remotely. And that's a great experience for us. In order to close those loans, we had to work virtually. We had to go through the whole process virtually, and we were able to do that. With that, I want to now go to the next slide and talk a little bit about the business model framework that we have. The vision that I just talked to you about has enabled us to actually focus on everything that you see to the left of our credit worthiness stage. In the past, most of our emphasis at the Bureau was on credit worthiness stage as well as portfolio management, but everything to the left, that line that you see that says final LOI, to the left of that has been our focus over the last couple of months. We have been working on different actions that we can take to develop new products, to maybe modify some of our products in order to have good tools that pretty much everyone can take advantage of them. Maybe some of our tools that are designed specifically for smaller projects would work for you, your organization. Maybe some of the ones that are designed for larger projects may work for you. We wanted to make sure that we have a variety of different tools and options, so pretty much everyone can find something that they can take advantage of. And what is really important, and I want to emphasize, is that technical assistance that you see in this chart. We have a dedicated team in place. These are experts who have worked at the state DOTs in the past on multiple projects that have been developed with innovative delivery models, and they are available to you. They can meet with you, they can assist you and your staff in terms of getting up to the speed about some of these new trends, some of these new options, and answer questions you may have about how to set up a program that can then work for you in-house to advance these concepts for you. So with that, I would like to now hand this presentation over to Roger, who is going to talk to you about some of the products that we have in place.
Thank you, Morteza. Today I'll be talking about our two primary loan programs, TIFIA and RIF, as well as, like Morteza had mentioned, a couple of new products that are tailored for borrowers that have not traditionally utilized the Bureau's services. The first one I'll talk about is the TIFIA loan program, which is basically intended to provide long-term, low-interest loans for surface transportation projects. For example, we can finance everything ranging from ports and freight facilities to roads, bridges, and tunnels, which is what we've more traditionally done, to transit systems, passenger facilities, and other projects, even including things like pedestrian paths and bike paths and things of that sort. Some of the advantages of TIFIA, probably first and foremost, is that we offer very low interest rate. It's tied to the U.S. Treasury rate. And for example, if you were to close a loan today with us, the interest rate would be fixed at less than 1.5%. Another one of the advantages is that we can provide a very long-term payment period. Not only can we provide loans out to 35 years, but we can also, in some cases, defer payments until 5 years after substantial completion of construction. So we can get out there beyond 40 years very easily. Also, very important to note that our loans involve no prepayment penalty. For TIFIA loans, we typically finance up to 33% of the eligible project costs. Another one of the advantages that we offer is that the borrowers draw the funds as they're needed. So while a project may involve a fairly substantial loan, it could be quite a bit of time from financial close to the first draw of that loan. And up until then, there would be no accrual of interest. And if that first draw is a small portion of the total loan, it's only the amount that's drawn that's accruing interest. And it's worth mentioning that this differs quite a bit from bonding, which is another method that project sponsors use to finance their projects, in that in the case of bonds, there are normally prepayment penalties. And usually with bonds, interest begins accruing as soon as the bonds are issued for the full amount. One of the other advantages of the TIFIA program is that we can highly customize the loan to fit the borrower's needs. One example of that is that we can adjust the amortization rate to meet the borrower's needs or their revenue streams for a project that might generate revenues in out years, but not early on. On the next slide, and to Morteza's point, we've recognized that historically there have been underserved communities, and certainly one of the better examples of that is rural communities. So we recognize that rural borrowers face unique challenges in funding and financing their projects. So we've developed this Rural Projects Initiative, which is the next thing I want to talk about. It's really a program within a program. It's basically TIFIA. However, it's got specific attributes targeted to rural borrowers. So first off, the definition of rural for this program is a project that would be outside of an urbanized area of a population greater than 150,000. And that's based on the latest Census Bureau data. And the project cost range to be eligible is between $10 and $100 million. For those projects, we can finance up to 49% of the eligible project costs, where with the legacy TIFIA program, we could only go up to 33%. Probably the most important aspect, though, is that we can charge a fixed rate of half the Treasury rate. So right now, it would be at somewhere around 0.75% fixed for up to 35 years. We can also cover some of the fees that the borrowers incur to apply for a loan. So this can really offer some additional benefits for rural borrowers to help them overcome some of the challenges I mentioned. On the next slide, I'll talk about our second loan program, which is called RIF. And basically, this is all things rail. Everything from freight and passenger rail projects to stations, facilities, rolling stock, track, even maintenance facilities and intermodal transfer facilities. It's got a lot of similar attributes to the TIFIA. For example, it's long-term fixed interest rates, flexible amortization, and so on. One of the biggest differences is that you can utilize it to finance up to 100% of the eligible project cost. Another difference is what we call the credit risk premium. So the credit risk premium is a premium that a borrower pays upfront, and it's determined by the degree of risk that the loan represents. And it can be anywhere from 0 to a very low risk loan and on up from there. While the borrower does pay that, there are a number of ways that they can manage that down. to be advantageous. Probably the most significant is by offering collateral. We can also work to adjust the interest rate and manage the credit risk premium down. I'll mention too that for RIF, the same interest rates would apply as TIFIA. So right now, a loan closing would be under 1.5% interest. So the difference between RIF and TIFIA primarily are the types of projects that they can finance, the amount of the project cost that we can finance, and TIFIA does not have the credit risk premium, whereas RIF does. And for RIF, I'll also mention that there is no minimum loan amount or maximum loan amount. So we've done loans from everywhere between $50,000 to about $2.5 billion. On the next slide, I'll talk about another one of our tailored products that, again, are focused on underserved borrowers. This, like TIFIA Rural Projects Initiative, is a program within a program, and it's called RIF Express. And it's aimed at the small freight railroads called Class 2 and Class 3 railroads. Again, it's very similar to the legacy RIF program in characteristics, and we can use it to finance up to 100% of the eligible project costs with a cap of $50 million for RIF Express. And for the projects that are eligible, we can speed up the processing of the loan request. We can finance up to 5% of that credit risk premium that I mentioned a moment ago. And if you look historically at the types of loans that would have been eligible for this, that covers most, if not all, of the credit risk premium for most borrowers. Under RIF Express, we can also cover up to $100,000 in fee assistance. And again, historically, that would have covered most, if not all, of the fee costs. This has a limited period of opportunity. So applications are being accepted through the 15th of this month, June 2020. And it's accepted on a first come and first served basis. I should mention that for all of these programs, both TIFIA RIF and the Rural Projects Initiative, as well as RIF Express, projects do need to meet certain federal requirements, such as environmental or NEPA and Buy America. And our team, the Outreach and Project Development team, has folks called project development leads. And what we do is we assign a project development lead to your project and help you work through those regulatory requirements, help you put together a plan of finance that can make it as viable as possible for when we hand the package off to the underwriters. And we can basically advocate for the project sponsor and serve as a single point of contact for that project. And that concludes my presentation. I'll turn the floor over to Duane to talk about some of the other products that we offer in the Bureau.
Thank you, Roger. As Roger just mentioned, he's run through two of the main credit programs that the Bureau provides, the TIFIA and the RIF programs, and a few of the initiatives that we have implemented to try to make programs more accessible. I'm going to talk about some other initiatives that we have to further broaden our pipeline and make our credit programs accessible to different types of project sponsors and different types of projects. Traditionally, especially on the TIFIA side, a lot of the loans have been larger for larger projects, and I actually have been in larger areas, urbanized areas, and we've made a real attempt to try to make the programs more accessible for folks at the state and the local levels. Under the FAST Act, one of those initiatives is our streamlined loan application process. In that process, if a project sponsor has a maximum loan amount request of $100 million and it's a public sector borrower, we can shape a process that will actually get you through a lot quicker. As Morteza mentioned earlier, some of the concerns that folks have had in the past about our programs are the length of time it takes to go through the entire approval process. But if you fall into this category for the streamlined process, we can move you very quickly. So some of the requirements under that are being a public sector borrower, having a revenue source that is highly rated. We have a minimum credit rating of A-. I mentioned that the loan amount is set at $100 million, so that's on the smaller side for some of the TIFIA loans that we've done in the past. And also, there are a few other requirements, including utilizing the non-project revenues template loan agreement. And that simply means that instead of renegotiating new terms, we would just take one of the draft agreements that we already have, and that cuts out a lot of time going back and forth trying to renegotiate a new document. And we also have one more requirement that the repayment of the loan commences no later than 5 years after full disbursement, so that we can cut out a lot of time shaping the amortization. So basically for these projects, we are trading off a lot of the flexibility that we have in the rest of the program with speed in being able to both analyze the projects during our underwriting phase and negotiating the final terms and finally getting the financial close. So for some of these projects, we're able to reach financial close from the time that Roger hands the projects over from the outreach group to the underwriting group within a 4 to 6 month window, as opposed to the 9 to 12 month window that some of the more typical loans take. So moving on to the next slide, another initiative that we have is the ability to make loans to state infrastructure banks for rural projects. Basically, we refer to this as basically loan to lenders. Typically, for TIFIA, we are lending into projects for a specific purpose, whether it be a bridge, a tunnel, a transit project, etc. In this case, we would be making a loan to a state infrastructure bank, basically as a block loan, and they would then do the on-lending to much smaller projects. And this will enable us to get to communities that have not traditionally accessed the program, and especially rural communities. So for this program to be eligible, the project has to be located outside a census-defined urbanized area, population greater than 150,000. So it's really meant for those rural projects as opposed to the large mega projects that we've had in the past in our portfolio. We talked about, Roger mentioned the interest rate. For these projects, we can lend actually at half of treasuries, which is half of what the typical rate would be for a typical TIFIA project. And we can lend up to 80% for this, as opposed to the TIFIA limit of 33% that we've done by practice in the past, 49% in some limited cases. Another benefit under this program is that we're able to waive the cost of advisor fees for loans that are under $75 million in this program. Typically, for a TIFIA loan, the project sponsor will pay for the cost of the advisors that we bring on board to help us analyze the project and document it, both financial, legal advisors, and other experts that we bring on board. Here, we have the ability to cover those costs in this scenario. We have a limited budget available to do that, but it is something that's available for the loans that we make to state infrastructure banks. And there's also a requirement for only one credit rating for these loans, as opposed to typical larger projects that require 2 credit ratings. And we have a few projects, a few states right now that we're engaged with, New Jersey being one of them, that are pursuing this option currently. Another initiative that we've tried to develop, and once again, this is going toward expanding our portfolio, is one where we're able to help project sponsors accelerate the delivery of their critical infrastructure. And it's one where typically for a typical TIFIA loan, we have the ability to go up to 35 years after substantial completion for the final maturity of the loan. But in some cases, there are sponsors who don't want or need a loan of that length, and they're looking for a much shorter borrowing. So in the case here, you can see the 2 different scenarios. Under the no TIFIA scenario, a project sponsor who does not have all of the funds available today, so they have $50 million in program funds for a project, but the rest of the program funds, say another $70 million, won't come to year 5, they might have to build that project in phases or wait to actually get the full benefits of the project. The project isn't delivered until year 7. But if you look in the second scenario with TIFIA, they can get the program funds from their state and borrow the balance from us today, go ahead and build the project. The project is delivered in year 2, and then once they actually receive the rest of the program funds, repay us down the road in year 5. So once again, they're not looking for a 35-year commitment. They needed a relatively shorter term loan facility, but we can also provide that as well. Another advantage or flexibility that we have with the program is that we have the ability to refinance existing debt, outstanding debt, with both the TIFIA and the RIF programs. The authority is slightly different under current legislation for TIFIA and RIF, where for TIFIA, the refinancing of outstanding debt requires that the refinancing would provide additional funding capacity for completion, enhancement, or expansion of an eligible project. So if you have a project that potentially might have cost overruns, you have the next phase of a project that you're intending to build, this might be a potential option. Under RIF, the refinancing authority does not have the requirement of the additional funding capacity, and the refi projects that are eligible are projects that would be normally eligible to apply for RIF. That typically would involve the acquisition, improvement, or rehabilitation of intermodal or rail equipment. Both programs also have the ability to defer debt service. For TIFIA, they're 2 different instances. When we have a project that's under construction, typically lots of our projects are capitalizing interest while they're under construction. Then there's the ability to defer payments for up to 5 years after substantial completion of those projects. So projects that are building up the revenue generation have some time for that to happen, and we have the ability to sculpt our amortization profile to match that. On the flip end, with projects that actually might have gotten into trouble or in distress scenarios where revenues are insufficient or lower than original projections, for RIF, we have the ability to defer payments for up to a year after the original payment plan. For TIFIA, we can defer somewhat indefinitely as long as we can re-amortize those payments through the final maturity of the loan. Both programs provide lots of flexibility that project sponsors find very helpful when they're trying to meet what might be constrained funding resources and also constrained revenue lines, especially if they have other debt in some of the projects that we're talking about. So all of these are things that are available to help projects move forward, where we can be flexible in some ways that possible other sources of debt could not or would not be able to. So with that, I'll conclude my slides and turn it back over to Morteza.
Okay, thank you guys so much, Duane and Roger, for your questions. For your comments. We're going to turn to questions in a moment. We have a few more poll questions. First, which products have you used before? Select all that apply. And as a result of this webinar I'm interested in, please select any answers that apply. Do you have a project that would benefit from one of our products? Great. I'm going to move on to some of the questions that we've gotten in. First question, again, I'll leave it to Duane or Roger to respond to this, but what are the most effective project delivery models that the Bureau has seen? I'm guessing that through the projects, through the finance tools that you're able to apply to some of these projects.
Roger, I could take the first stab. I would say, given, as Morteza and Roger mentioned, we have a very wide range of projects in our portfolio across the RIF program and the TIFIA program. As Roger mentioned, projects on the very small scale to mega projects, and they encompass all kinds of different delivery methods, whether we're talking about design build, design bid build, public-private partnerships that have a DBFOM, construction and manager at risk. And I think we've had success stories across the board. I mean, there have been obviously instances where projects have run into different issues, as will happen with any kind of infrastructure projects if you have enough of them. But all of them, if they're well structured, well kind of planned and programmed, and the security package and the financing is structured in a good way, we've had very good outcomes across the board on all of them. And I think it really is not a one-size-fits-all. Certain things fit better in certain scenarios, and that's part of the conversation project sponsors should be having early on as they're figuring out which road to go down. And also it has to do with what the revenue sources that's available, the timing, etc. So any and all of those can be successful, and we have seen that in our portfolio.
Great. We'll move on to another question. This is one I think that, probably you hear a lot when it comes to TIFIA financing. Does a project need to have revenue coming in through tolls to qualify for the TIFIA credit assistance program?
Yeah, I was just going to say that that's a very good question, and we encounter that quite a bit. We actually can work with revenue streams. While some can be tolls, we work with a wide variety of revenue streams that can repay loans, even in some cases, things such as the sale of air rights, lawsuit settlements, various different types of tax revenues and things of that sort. And one of the things I did want to make sure I mentioned is that one of the things we encourage people not to do is self-select out. Sometimes people think there's only one kind of structure that works, or we can only finance one type of project. And I would encourage folks to reach out to the Bureau early on, because there are a lot of ways we can find an innovative approach and help projects sponsors deliver their project through a variety of different ways, be it revenue streams, and just structures and other mechanisms.
And following on Roger's comment, the only requirement for TIFIA is that there is a dedicated repayment source, but across the portfolio, that repayment source has been toll revenue, sales tax, appropriations credits, hotel and use tax, lease payments, etc. So as long as the project sponsor has the legal authority to pledge whatever revenue, and that we can get comfortable from a credit standpoint that it's sufficient, we have a lot of flexibility in what we can accept.
Great, thank you so much. In the presentation, you all did mention underserved stakeholders and folks that have not taken advantage of Bureau offerings and products in the past. So we did get a question about your definition of underserved stakeholders and communities. Is that in the context of the state level or community-based? I mean, how are you looking at that through a lens of, levels of municipality and levels of jurisdiction?
This is Roger. There's really a couple of ways we look at that. One is we, for both RIF and TIFIA, we can loan to a wide variety of borrowers, everybody from a state Department of Transportation down to private entities and local jurisdictions. So when we talk about underserved, in one regard, it's the type of borrower that we've not necessarily seen as well represented as others. So smaller jurisdictions, county, city level versus state DOTs, also private borrowers. I mentioned the RIF Express program that's aimed at short line and regional railroads. Of our funding that's available to finance those loans, up to $7 billion is supposed to be set aside for those entities. And we've not done nearly $7 billion of loans. So by saying underserved, what we mean is either project sponsors or asset classes that are not as well represented in our portfolio of loans as others.
Thanks so much. We'll roll right along. I know there has been discussion at the legislative level about expanding TIFIA eligibility to include airport projects. So we did have a question about that, basically asking if that project eligibility for TIFIA has been extended to airport development projects. I know at one point, in order for a project to be eligible for TIFIA, an airport needed public transit access. So can you talk a little bit about the role of TIFIA with regards to airport projects?
We do have authority to finance public infrastructure that has a transit nexus. So among other things, that could be airport terminals that are served by a form of transit. Currently, that's the only existing authority we have that could finance airports. We've not done one of those loans at this point, but it is something under consideration. Okay,
thank you. A question here about project cost and sort of the makeup between state and FHWA funding. The question was, can TIFIA and FHWA funding make up 100% of project cost if the TIFIA loan is state backed?
No, the existing requirement is that TIFIA, as was mentioned earlier, can go practically, for most cases, up to 33%. We have a few cases where it can go up to 49% that we mentioned earlier in terms of the TIFIA RPI program. There's an overall 80% federal assistance cap that would include TIFIA and any other federal grant funding, so that overall TIFIA can only be, or TIFIA plus any other federal funding can only be 80% of total project cost.
Thanks. That's a nice segue to some questions that we have gotten about RPI. must an RPI project be exclusively rural, or can a portion be in an urban area as defined by the Bureau? Having worked on some of these issues for a long time, I know there are many definitions of what is rural based on which agency you're interacting with. So if you could expand a little bit about that project location aspect and the population threshold.
Great, happy to. First off, the definition of rural for the TIFIA program is legislated by Congress. So you are correct. There are other grant programs throughout DOT and other programs throughout the government that use different thresholds as the definition of rural. Again, because it's legislated, is one we don't have any flexibility with. I think the other half of the question is important as well, as many transportation projects are not a point on a map, but rather a line or a number of lines on the map. We do encounter proposals where a portion of the project can be in a rural area, and a portion of it could be in an area that doesn't qualify as rural. And I would encourage anybody that's contemplating one of those projects to give us a call, and we can work with the project sponsors. Generally speaking, if more than 2/3 of the project costs are incurred in a rural area, then it could be considered a rural project. But each project is different, and we're happy to work with sponsors to take a close look at it and see what we can do.
Thanks. Okay, here's an interesting one. It's my understanding that TIFIA gets appropriated funds every year, but we did get a question about what happens if TIFIA funding were to run out.
Well, as you mentioned, TIFIA has, under the existing appropriation, gets roughly about $300 million a year in budget authority that represents multiples of that in actual lending authority, lending capacity. In addition to that money, we have carryover authority that we've had from previous years. So we actually have quite a bit of money available for lending to projects. We can lend as far as that authority takes us, in essence. So we're not concerned at the moment in terms of capacity, because we have a lot of capacity. If that were to run out and there was not a new authorization in place, then we would no longer be able to lend additional funds. But just to be clear, we have lots of available lending capacity at the moment.
And that kind of dovetails nicely to the next question we have, which is related to authorization. Can you just clarify for the group or reiterate for the group when the authorization for TIFIA expires? It's tied to surface transportation reauthorization, correct?
Correct. So the FAST Act obviously expires at the end of this fiscal year. Assuming that we are still operating, which would mean if there's not a new bill in place, we would be on some kind of continuing resolution for appropriations and some continuation, some shorter term continuation of our authorization. So we would still be functioning underneath that, whatever the terms and length of that extension was. And the money that we currently have available would be available to us in some portion of that. So if there, we had a half-year bill, we'd have half of our available authority available, or the new authority.
Great. Would like to get into a couple of sort of modally specific questions. We've gotten one about port and port-related projects. And they just said, can you address port options? But I'd be curious to hear any examples you have of projects that involve port improvements that have been able to utilize some of your products.
Well, first off, for TIFIA, TIFIA can finance a surface transportation project that's within a port's boundaries that directly facilitates the intermodal transfer of freight. So when you think about how a commercial seaport operates, almost everything that it does facilitates the transfer of freight. So there's a number of types of projects that can be eligible under the TIFIA statute. Additionally, under the RIF program, as I had mentioned, RIF can finance almost all things rail, and there's a great number of on-dock and near-dock rail projects that can be inside a port facility that we can finance. We just recently did a rail expansion in the Pacific Northwest using a RIF loan.
Thank you. And that ties to another question about rail-related projects. Give me 1 second to pull it up. Which funds would be most appropriate for railroad undercrossings and overcrossings and at grade crossings? I know there's a program dedicated within Federal Highway for that purpose, for those intersections between highway and rail crossings. But has that been a usage of RIF funding in the past, or would it be an allowable use?
I think that's one where we would want to look at.
Yeah.
Okay. Oh, go ahead, Duane.
Yeah, no, I was going to say, I believe that, rail crossings would be eligible under RIF, but I believe what Roger was going to also say is every project looks a little bit different. So we would encourage everyone who has a potential project to come in and start talking to our outreach folks to make very clear exactly what that project is, and we can give them, a more definitive answer about eligibility.
Yeah, and building on Duane's point, there are some types of projects that can be financed both by RIF and by TIFIA. And as I mentioned, there are some important nuanced differences between the two programs. And that's one of the reasons we really encourage sponsors to come and talk to us early on, because in the example that you just gave, we can figure out which of the programs optimizes the project sponsor's needs. Another example where both programs could finance something is an intermodal freight transfer facility, where again, based on the advantages of TIF and RIF, we can work with the project sponsor and dial in the most advantageous credit program to meet their needs.
Excellent. Here's one. Are there any additional specific requirements besides what the FHWA requires from all federal aid projects that the state DOT borrower needs to adhere to when it comes to a TIF or RIFIA loan? RIFIA, you've probably heard that before. A TIFIA or RIF loan?
Both loan programs. Both loan programs follow the federal requirements of the respective modal agencies. So for TIFIA, which has kind of a wide range of eligibility, if we were doing a highway project, we'd be looking toward the highway rules. It was mentioned earlier, pertaining to NEPA, uniform relocation, DBE, et cetera, et cetera. TIFIA, the only, and the same thing for RIF, or if it was a TIFIA transit project, we'd be looking to the transit agency. If it's a RIF loan, we'd be looking to FRA requirements. The requirements specific to the loan programs are more on the side having to do with the financing, and then some other requirements that Congress has put in place in terms of what the structure of the financing could be, where we are in terms of priority of payment, what the sponsor has to provide in terms of ratings for the TIFIA program and other things like that. But most of those are on the financing side or the credit side. Most of the federal requirements are ones that are what the modes would require for any other project receiving federal funding.
Okay. Another sort of procedural and policy type question. Are there specific rules, policies, or guidance that the state DOT has to follow for screening a project? Any new requirements for environmental analysis, right-of-way acquisition process, value for money analysis, etc.?
The one that I would think of is the last you would mention when you say new, so ones that they didn't already have to follow. There is a requirement for, I think, all projects under applying for the TIFIA program that would be looking they'd have to do some kind of value for money or similar process as they're considering how to go about procuring the project. But that's not a specific requirement for TIFIA, I think is a requirement in general. So they're not, off the top of my head, and Roger, please jump in, there are not a lot of other requirements separate from that a project that don't already apply to projects receiving federal funding.
That's right. The one thing I would add to Duane's point is that for TIFIA, some costs prior to the date of receiving the loan can be eligible under the TIFIA program. However, that requires that the procurement be done in a certain manner that meets the TIFIA and the federal requirements. So it's, you know, if a sponsor is considering a TIFIA loan, it would be very helpful for them to speak to us before they incurred some of the, you know, the expenses that could lead up to the loan. For example, design, engineering, right-of-way acquisition, and so on and so forth. If those are procured in a manner consistent with the federal requirements, then that could be eligible for the TIFIA loan. So we definitely encourage sponsors to talk to us if they have any questions about that prior to incurring costs.
Okay, here's a timely one. How will the President's executive order issued last week on streamlining environmental regulations impact NEPA requirements for these programs?
Well, those streamlining processes that are outlined will be what the department utilizes and adheres to. So any environmental streamlining that the administration implements would also apply to the environmental streamlining and review processes for both TIFIA and RIF.
Gotcha. Next question. Any specific guidance or requirements for public interest findings? I have to admit, I don't know if I know what that is.
It may be the question, well, let me answer the question that might have been asked. We do see projects that are more controversial run into you know, delays, increased costs, and uncertainties. So in terms of public interest, you know, the sponsors are well advised to really communicate well with the community what the project is about, you know, what the benefits are to the public, what the costs are, because the projects tend to proceed much more smoothly if there is public support. So I'm not sure if that was the question that was intended.
Okay, we'll see if we get any further follow-up on that, but we have time for maybe a couple more. I think maybe it would be timely to perhaps talk a little bit about COVID-19 and how it might affect, or how it may be impacting people's abilities to use your products. So one question is, if a project's cash flow is weak due to the pandemic, how can I still use the Bureau's products to help? And maybe related to that, what's your outlook on the credit market? Are you seeing a higher number of projects default because of the pandemic? That's certainly something that BATIC Institute and AASHTO has been asked frequently. Some of the consequences of the credit market. So I'd love to hear y'all's thoughts on that.
So putting COVID aside for a second and just talking about any particular project and their cash flow, one of the, we mentioned the interest rate and how that can be very attractive to sponsors, but in some cases even more attractive are the flexibilities that the TIFIA and the RIF program provide in terms of structuring that help project sponsors that have projects that, if it's a true project financing where you're building a project like a toll road or something else that will then generate revenue that will then repay the debt, you need some time for those revenues to grow. So we have the ability to capitalize interest during construction. We have the ability to defer payments for up to 5 years after substantial completion. So it gives kind of a ramp up period for those projects for revenues to grow. And even after that, we have the ability to structure our amortization around the available revenue and potentially around other debt that's in the project, given that in some of the cases we're not able to lend the full cost of the project. So that with all that flexibility, we're able to structure financing where our project is able to meet our requirements, but knowing that they might have a constrained revenue source over, a 35-year period where it's going to grow over time. So those flexibilities allow us to still do a deal when a project doesn't have all the revenue today that it will have in the future, but we can structure our payments around that. Turning to COVID, we obviously have spent a lot of time over the last 3-4 months contacting all of our existing borrowers across both programs to see what the COVID impacts are. And while some of those are still being figured out and analyzed by our sponsors, we have not seen an uptick in projects defaulting so far, and some of that is related to how we go about doing the structuring of our financings. We have a very rigorous underwriting practice where we're trying to make sure that the revenues that are projected for the project are sufficient. So we'll often take haircuts to projections that we receive. We'll look for certain coverage above what's needed to make our debt service payments, so that there's some cushion if something should happen, if there should be an economic downturn, or for some other reason project revenues are not what was originally projected. There's also liquidity that's built into these projects in terms of debt service reserve funds, some of the flexibilities I mentioned earlier. We put all that together to end up with what we think is a very resilient financing structure that can take a few hits from economic downturns or other things that might happen during the course of the project repayment period. So that we think there's a lot of resiliency in the deals that we've structured, that they can withstand a period of time where revenues are less than originally projected, or even potentially the period we're going through where, lots of people, no one really projected a COVID scenario where revenues would drop by 80 or 90%, but because of, depending on the nature of the project we're talking about, but because of the resiliency we build into the structures, they have some ability to withstand that.
And I think for many of the reasons that Duane just mentioned, we take a very long view on our credit, and many project sponsors recognize that, these facilities are built and last for, 75 or 100 years. So while this COVID crisis at the moment is first and foremost in people's minds, many project sponsors that we're talking to who are working towards a loan, have said that they want to continue towards the financial close. Really, probably the majority. There are some projects that have said, well, we're gonna pause for a little bit and see what comes out of this, but that is certainly not the majority. And as Morteza mentioned at the beginning of the webinar, we've actually closed 2 loans during the COVID crisis, operating remotely. So our pace is largely similar to what it was prior to this crisis.
Roger, thank you very much. And, I just wanted to take advantage of the few seconds that we have left to end the webinar to just reiterate a couple of points that we are open for business. We want to partner with you to identify opportunities, especially if you haven't used our products in the past. And we want to make sure that we make the process as simple as possible, as fast and efficient as possible we can make. We're open to get ideas from you, feedback from you, and we are always promoting outside the box thinking, innovative approaches. We have a dedicated team in place, and we are looking forward to connect with you and work with you to identify opportunities and try to bring them to reality. So with that, I think we are almost out of time. If you need additional help from us, if you want to connect with us, our contact information is at the end of this presentation. You can also go to our website, connect with us. We are more than happy to have further conversation with you, more detailed conversation with you on a specific projects that you may have, or if you want webinar in your state to discuss same topics that we discussed today with more people in your state. We're also happy to schedule webinars with different associations, different state DOTs to go and talk about some of these topics in your backyard. So with that, I want to thank everyone for this webinar, BATIC Institute, who helped us to bring this to you. This is going to be uploaded on the internet as well, on BATIC website as well as our website, and we are Looking forward to work with you in the future. Thank you very much, everyone.